Hi, Dean Jenkins with FollowMeTrades.com with an update for the week coming up of September 20th, 2015. This is the market update, and always I'm going to take a look at the headlines first. So last week I said that the really big deal coming was the Thursday, September 17th announcement from the Fed about whether they were going to raise interest rates or not. If you've been following the news, then they said they are not going to raise interest rates at this time, and it did cause some volatility in the markets. Let's take a look at a couple headlines. Here's a headline I think that matters, and it kind of sums it up. And this headline from Reuters, Friday 9/18, says Wall Street ends down after Fed stokes global economic fears. And there are global economic fears, and that's what the Fed said. Janet Yellen, the chair of the Federal Reserve, said in her comments that there was a lot of concern about global markets and about instability and all this kind of stuff going on. And investors and the market in general do not like uncertainty. And what we have now is some economic fears, some uncertainty going on. I thought it would be helpful to take a look real quick at what is the Federal Reserve's primary responsibility? And their primary responsibility is, here's a statement from their website, and their primary responsibility is full employment and stable prices. And stable prices are about inflation. So they may be concerned about global markets and uncertainty and energy prices and all that kind of stuff, but they're worried about that in the context of fulfilling their responsibility here, which is full employment and sustainable inflation. Those are their real goals. So let's look at those indicators just real quick. Not to make this a class in macroeconomics or anything, but I think it's helpful to see what's going on, that's driving their actions. So here's a chart on new jobless claims. And you can see there's a very clear downtrend in jobless claims, the number of people who lost their jobs and are filing for unemployment benefits. The Fed does not want to interrupt that trend. They want that trend to keep going. And if you see the line at the bottom of the screen, the other thing the Fed is responsible for is one of their primary responsibilities is sustainable inflation rate. Their target right now is 2%. Our current inflation rate is 0.2%, so 10 times less than they would like it to be. Again, a whole big macroeconomics discussion of why they want inflation to be at 2%, but they do. And to get to 2%, they need economic growth, they need people working, all that stuff. So that's these are the dials they are trying to move with economic policy, and the interest rates are their primary tool. So given this context that the Fed is responsible for and concerned with full employment and getting to the target inflation rate, what reports do they look at that matter to them? Well, one of the key reports they look at are jobless claims. So next week on the economic reports calendar, jobless claims are reported on Thursday. Before that, there's really no big news. So I think we're going to see the market with kind of an absence of big news to move it through most of the week. Then on Thursday we get the jobless claims report, and on Friday we get the GDP report, which is also important. So in the absence of news, we may see some up and down, some volatility in the market, but no real major directional trend information or price movement. So with that backdrop, let's now go take a look at the charts, the reality of price action, of what investors and traders are doing, how they're responding to the Fed's move or lack of a move, and the upcoming information. So we'll go to the charts now. So here's the Dow Jones Industrial Average daily chart. And if you remember last week, I drew a wedge, this pattern here, and I said that that was really an unstable formation, and that as price movement compressed down, that it couldn't stay there and it had to break out.
and it did break out. Initially, it went up for a couple days. Then this is the day where the Fed announced their decision not to increase interest rates. And you see, there was quite a bit of price movement. And if you look the top here to the bottom here, that's from 2 days, Thursday and Friday. That's a 600 point move. So that's a pretty volatile set of trading days. So I'll go ahead and take those lines off the chart. So the real question now is what's going to happen? What's next? And I said that there's really no big news coming out. Monday, Tuesday, Wednesday, no market moving reports. Of course, there can be unexpected things, geopolitical stuff, but in terms of schedule reports, there's really nothing coming out. And I think that we'll get some minor movement either way, just some back and forth here until Thursday. Thursday, the jobless claims report comes out, then Friday we get GDP. And I think that's when we'll start to see some dramatic movement. And it could be that the market actually goes up. Again, my forecast on the longer term trend is that we're in a bear market. But let's go look at the weekly chart real quick, and that'll help clear it up just a little bit. So here's the weekly chart for the Dow Jones. So we were looking at the daily chart where every price bar was a day, and this is a weekly chart. So every price bar on here represents a full week's worth of trading. So I've refined my targets. I said I'm convinced we're in a bear market, that the market's going down in a natural, normal, healthy corrective cycle. And that corrective zone is between these blue lines. It's into this area here. And I've refined it a bit as prices played out. So that corrective zone is between 14,429 and 1203. So high probability that over time, over the next series of months, the price will make its way down into this zone. So that's a pretty sizable correction from the highs and even from where we're at right now. I wanted to show there's a pattern that is very typical. So we're in what's called a corrective wave, a correction from this big long uptrend here. And it's very typical, very normal for a corrective wave to move in what is called an ABC pattern. And that would look something like this. It could be down to here, up to here, and down then. And of course it won't be that smooth, but it's very typical to see this kind of thing. And so this what we call B wave could be happening now. We could go up again. I don't think we'll get over this green line, this high here at 17,568, but we could have some kind of pull back up before we head back down. And the reports coming out at the end of this week could be something that trigger that, or it could be news later on. But again, my outlook is bearish. I think the market is going down into this range here. Here's the S&P 500 chart. So if you're interested in what are the targets for the S&P, I was showing the Dow Industrial Average. So this is the S&P 500 index, and the range for this is right here between 1853, and I just wrote over my number. I can't see it. 1678. So between these blue lines, 1853 to 1658 would be the corrective range for the S&P 500. And maybe you're wondering, okay, Dean, thanks for that information, but what do I do? What do I do? Well, me personally, if I'm I'm not going to sit there and let my 401k, my IRA, my investments go down. If I think there's a high probability, there's evidence that the market is going down, I have no interest in watching my account shrink by 10 or 20 or 30%. No interest at all. And you shouldn't have to do that either. Now, one thing you can do is subscribe to my stock pick service. I'm biased. I think it's great. You can see my results here, though. Year to date, Dow Jones is down 6%. The S&P is down 3%. My trades are up 26% year to date. We're doing great. As the market was going down, we were making money, and doing that with low risk. So that's one thing, is subscribe to my stock pick service if you don't already. If you're not into that, it's not your thing, that's fine. I personally, if I wasn't willing or wanted to trade more actively, I would move my money to cash. I would simply get out of the whatever stock mutual funds or whatever I'm in and go to a money market fund until things change. I'd rather make zero than to lose, again, 10, 20, 30%. I'm not your financial advisor. I don't know your situation, but that's what I would do. If I didn't want to trade actively, I would at least not lose money. So I'll show you one other thing real quick. This is a chart for gold. This is an ETF, exchange traded fund. So gold has a pretty much, for the most part, an inverse relationship to the stock market. So when the stock market's going up, the price of gold is going down. When the stock market starts coming down, gold starts going up. Usually, you can see gold has come down a tremendous amount as the stock market went up. Gold is considered a safe haven. It's where investors go when the stock market is going down. Now, so gold may be one place to move your money if you don't know anything else to do. And this is not the late night cable TV guys talking about buying bullion and coins and all this. This is an exchange traded fund. It trades just like a stock. You can buy it in your IRA. Depending on your plan administrator, you may be able to buy it in your 401k as well. So gold has not proven that it has started up yet, but it's showing early signs that it may. And if it does, this is the range. This is the range that it would go up to. Currently trading at 109. It could go up to 130 to 147. That's, 25 to 35% increase. So that could be a very simple, safe thing to do. Is once this is proven, and here we've got a higher high, higher lower, higher low. If it goes and takes out this high on the stock market, keeps going down, this is then beginning to prove that it's going to go up. So I'll provide updates on that on an ongoing basis, and if that's something you're interested in. So that's the update for the week. Expect some back and forth, but no real direction. Early Thursday when the unemployment report comes out, Friday when the GDP comes out, we'll probably get some more volatility, some more movement. Still bearish for the long term, and we'll just keep watching it, and I'll keep providing updates. So thanks. Always send me questions. Dean@followmetrades.com. Love hearing from subscribers. I'll answer your questions, and we'll catch you next week. Thanks.